First idea, Metro.
So Metro is one that we've had in the portfolio before we came out of Metro. The stock right now fits the bill on a couple of fronts, Andy. One is a defensive stock. We're starting to get a little bit more defensive in the portfolio. Metro, we think, is going to be a well-positioned part of that defensive strategy. A lot of its CapEx spending has already been done. It's revamped its stores. It's done a great job of that. We've gone through the strike in the GTA. That was finished with back in August. So we think right now the stock is in a great position now to start seeing some upward movement. And this is going to be a re-add for us in the portfolio.
Do you think much will come out of the MPs calling the grocery CEOs to account?
I don't think so, right? I don't think so. I don't think it did before. And, you know, I think there's going to be more focus right now, not on what's happening to food prices. I think you're going to have more focus now on what's happening to gasoline prices and oil prices. So, no, I'm not that worried about that. And they're going to be in the same, you know, basket as everyone else. We just think if we were picking a stock right now in the grocery segment of the market for defensive reasons, we think they've done all the hard work, all the heavy lifting, and now they're going to be one of those better plays over the next 1 to 2 years.
Your next idea, Rogers Communications.
Yeah, another re-add. You know, Rogers used to be in the portfolio, went through a lot of noise with respect to the Shaw acquisition. It looks as though the integration of Shaw is running apace. We think that's a positive for this stock. We think it's got good penetration into new Canadians, for example, coming into Canada, where we've seen an explosion in population growth. We think Rogers probably does a little bit better at the margin on that. And we think the valuations now are attractive now to come back into the stock going forward.
That's it. Yeah, I mean, they've been through their leadership struggle. They've completed the Shaw transaction. So a lot of noise, as you say, was surrounding Rogers.
Yeah, and that's one of the reasons we came out of it prior to that was that just take the money off the table. But it's like looking at a stock like Metro, where we've done, again, a lot of the work in terms of CapEx, where you may actually use that against playing into a stock like Metro. And now we've basically done it. And now we're going to utilize what we put into place. And we think the demand or their market share continues to grow.
And then finally, Andlauer Healthcare Group. Just remind us what they do. Tell us why you like it.
So this is a logistics company at the end of the day, Andy, and specifically they're looked at for medical logistics. So think about shipping vaccines or shipping drugs. Regulations require that the shipment of a lot of these products has to be done in a refrigerated truck. Okay. So 60% of the business for Andlauer basically is in that business. And we think the demand for that is going to increase going forward. The company's well run. And we just think right now the valuations, despite some earnings that have not been too bad, really don't reflect the longer term value for the stock going forward. So this is a smaller cap play for us in the portfolio, but we do think it's going to generate decent returns going forward.
And probably sticky. I mean, if you've got your healthcare stuff coming by a carrier, they'd really need to mess up before you fired them, I'd say.
Well, exactly right. And so whenever you're dealing with a company that has to adhere to regulations, a couple of things. First of all, you don't get a lot of entrants into that segment, which they don't have. I mean, this is a big player in North America, huge player in Canada. And so it's almost like a guaranteed market share at the end of the day. Nothing's guaranteed, obviously. But if you think about long-term demand for healthcare, why do we have healthcare stocks in a portfolio? Because healthcare is pretty defensive. If we have a recession, people still have to be treated. And why do we want a company like this? Because we've got to fulfill those logistical requirements of healthcare entities, and that's what this company does.
Andrew, thank you very much indeed.
Pleasure, Andy.
First idea is BCE, the parent of BNN Bloomberg.
And that's not why we picked it, but it adds to the attractiveness, of course. BCE is the classic income stock. We've got clients who've owned it for 50 years, who inherited it from their parents or their grandparents. The dividend just keeps going up year over year over year. And the stock usually appreciates modestly, not lately. As we've talked about with all income stocks right now, it's in the toilet. Great time to buy a dividend yield of 7.2%. Cash on cash. They're finishing their fiber optic and 5G build out, which means that there's going to be lots of cash flow, which means they might be able to increase their dividend. It's the least indebted of the three big telcos as a percentage of its asset base. And, I think it's oversold at this point. There's nothing wrong with the company. It's simply the fact that bonds are perceived as more attractive. Well, that's not going to last forever.
Is it going to be an overhang, though, or perception that we're in for more wireless competition in the long term?
You know, it's another one of these Canadian industries that's an oligopoly. You know, as much as the CRTC and the anti-competition guys try, it's really still a three-player market, and everybody seems to manage fine.
Canadian apartment properties, the biggest apartment landlord in Canada, is your next idea. And obviously, rent. I mean, rent is just...
Rents are going up like crazy.
It's sucking people dry in many centres.
Well, that's perhaps not a polite way of looking at the company, Andy, but...
No, I don't mean them just, but I mean, it's so tough on people.
It is. It's very hard on people. So, of course, like all big landlords, they have a blend of rent-controlled apartments and apartments that aren't rent-controlled. And they also have opportunities to build. I think one of the things that's going to happen is the municipalities and provinces are going to be under tremendous pressure to change zoning laws to make it easier to build multi-unit residential. So, you know, where we used to require one parking space for every, 1.5 units, I think that might go by the board. People are going to say, we don't need that anymore with bike lanes and e-bikes and so forth.
Yeah.
You know, maybe one parking for every 5, which frees up a lot of parking space you can build on if you're a cap REIT. I think they're also going to be making strategic acquisitions from companies that bought and paid too much and are now burdened by debt. So this is a great platform, very, very well-run company, always has been. And you get a reasonable yield at the moment, not terrific, but reasonable. And we think that's going to go up in the future. So, when people complain about gas prices, I say, so buy some Suncor. When they complain about bank fees, I say, well, buy some TD Bank. Well, if you're complaining about rents, buy some cap REIT.
Okay. Tourmaline, now you discuss your bullish thesis on natural gas. You think as we move to more renewables, we're going to need this backup power, and it's probably got to be gas?
I read a book recently that opened my eyes, and it made me feel stupid, which is never a bad thing. It was called How the World Really Works.
Oh, yes.
And it was written by a professor at the University of Manitoba named Vaclav Smil, S-M-I-L. And what he points out in this book is that the 4 cornerstones of modern civilization all depend on fossil fuels. And he defines those 4 cornerstones as fertilizer-driven agriculture, which depends on ammonia, without which 2 billion people would probably be starving. Cement, which requires natural gas to make. Steel, which requires fossil fuel, and plastics, which of course are derived from fossil fuels. He says those are the 4 cornerstones of modern civilization, and even if every car on the planet was an EV,
we'd still need them?
We'd still need them, and there's no getting away from them. And as I said when we were discussing earlier, the more solar and the more wind power we have, the more we're going to need natural gas plants as a backup. So we're building our position in Tourmaline. It's probably, in our view, the best of the Canadian companies. It's got tremendous reserves. It's a very well-run company. It pays a nice yield to investors. And we think that it's one to own for a long time.
Yeah, I've asked Vaclav Smil to join us, but he doesn't do TV, apparently, or he's not that keen on it.
Yeah, it's a book, as I say, that opened my eyes. And I didn't recognize how important, for example, ammonia was in the world economy.
Yes. The nitrogen fertilizer comes from it. Yeah. How the world really works, the science behind how we got here and where we're going. Yeah, I listened to it on audio, actually. That's how I listen to a lot of books. And I think he said that we get in a flap about apps and social media, but the world really relies on these physical...
These four cornerstones, as he calls it. And it made me think that our policy of carbon taxation in Canada is really misguided. If we want to make food more expensive, have a carbon tax that makes fertilizer more expensive, well, that works. If we want to make steel more expensive, if we want to make concrete more expensive, so that buildings are more expensive. Have a carbon tax. I think it's misguided and wrong.
I suppose the idea is that companies will be induced to find ways of making these things with less energy. That's why they put the carbon tax on.
Maybe.
Yeah.
But I have to tell you, saying that we can't use plastic straws isn't going to change the economics of these things.
No, it seems like tinkering. Okay.
That's it.
First idea, Intel. You said already you like what the CEO is doing.
It's funny with when I got together with the team and we were going through sort of what the top picks were, and everyone convinced me that we should do Intel, and we've been building a position in various portfolios. I never thought I'd say this, but because if you go back over the years, Intel is always sort of disappointed. But if you go back, 5 to 10 years ago, they were the king of the hill. But then, they just weren't delivering. But now, Pat Gesslinger, who's the CEO, I guess he's been around for a couple of years ago. He's just executed. He's told the analysts what the milestones are, and he's delivered. So there's a lot of good things that are happening within Intel. Currently trading 35.5. So you can see it on the chart. It actually rolled over. They're having their big annual conference in San Jose this week, and it's called the Innovations Conference. And late yesterday, when the CFO came on, he just wasn't as upbeat as Gesslinger and some of the other guys. And so it sort of rolled over. I think this is a tremendous place to actually buy it, down around here, around the sort of 34, 35, 36 level. And we have a 12-month price target of $49.50. So Intel, it's in the manufacturing space. So they both design and they also manufacture, which is unusual out there. I guess not many others, like when we were just talking about Taiwan Semiconductor, they don't design, they just manufacture. And so Intel has a lot of fascinating things that are going on. They've come out with this Gaudi and the new AI accelerator chip that will actually be very, very competitive with NVIDIA's. So they have these Gaudi AI chips and then the Falcon Shores GPUs. And it's it's more energy efficient than NVIDIA's, has everything going on. I could go on and on because they also have some advanced packaging that is going on, and actually how they stack the transistors and the chips together. So tremendous opportunities, and I never thought I'd say this, but I think they're going to do very, very well.
Visa, sorry, Kim, to cut you off. Visa is your next idea.
Yeah. So Visa, you're never sure whether you're going to end up going into a slowdown, heaven forbid a recession. Visa is a good choice when it comes to sort of recession-proof. But it's not just a credit card company. It's a global payments company out there, currently trading right around just shy of 244. We have a 12-month price target of 281.5. And so it just has a lot beyond just sort of the credit card. And Andy, it's $500 billion market cap. And, it reported back July 25th, they beat in the top, beat on the bottom. Their growth rates are great. Payments growths are 10%. Processing is 10%. International transactions are up 15% just in the quarter. Data processing is up 15%. They've done a lot of collaboration. They got in with this group called Confirma Pay, which is really extending their strategic partnership and enhancing sort of the whole Visa commercial pay side of things. They got in with a company called PaySend, which are sending real-time money to Visa cards out there. So there's a lot going on in Visa land.
Okay, we better move you on
yeah.
here.
Sorry.
Applied Materials, a supplier to the chip industry.
Yeah, the equipment suppliers. So you got the names of Applied Materials. You have ASML, which is on the lithography side. Applied Materials has actually got into the lithography side now, and so it supplies the equipment, services, and software for the manufacture of semiconductor chips and for electronics and flat screens and so on. Currently trading just shy of $139. We have a 12-month price target of $156.60. It's international. Most recent earnings beating the top, beating the bottom. They just announced that they're going to be launching this multi-billion-dollar research and development platform in Silicon Valley that is driving the semiconductor innovation side. So they just have a lot going for them.
Kim, thank you very much indeed.
Okay.
Topic number one, Fortis, the utility.
That's right, electric utility. It's one of our core income stocks. And so we actually think this is a very good time to build a position in Fortis, given the headwinds income stocks in general have had this past year with higher interest rates. Fortis just had their investor day a couple days ago, reaffirmed annual dividend growth of 46% to 2028, based on their backlog of projects in place, investment grade balance sheet.
What is the dividend growth again? Sorry.
46% annually till 2028. So once again, an income stock that has an attractive yield. It's 4.2%. But that dividend is going to keep growing every year as well. So in relation to, let's say, a bond investment, I think 10-year treasuries in Canada are around 4%. So it's slightly below the 4.2 in the yield. But I do think Fortis can grow their share price, a bit every year as well. So on a total return basis, I think it's very much more attractive from a longer term perspective. And so, this company, more than half its revenues come from the United States. Strong balance sheet, investment grade balance sheet, very reasonable payout ratio based on earnings as well as cash flow.
Okay, yeah. So the Canadian 10-year bond yield, I'm looking at about 3.75%.
Okay,
yeah, not far off 4.
Yeah.
So this is yielding a little more than the bond
4.2 now.
Yeah. Mondelez International, the global snack food player.
That's right. Global Snacks, one global leading share in biscuits, and then number 2 in chocolate, and they're actually growing their share in chocolate. And the reason why we like this company, it's been a core consumer staples name for quite a while. And I was asked to contribute to an article, Andy, and the topic was, a stock to hold for the decade, and actually put Mondelez as a name to own for the decade. And why is that? I think the categories they're in, people continue to consume biscuits and chocolate. Very little private label competition. It's about 10% in biscuits and 5% in chocolate. So there's very large brand loyalty.
I wonder why that is in biscuits. Yeah.
I'm not sure. I mean, it's just, and they grew their share during COVID when everyone was buying brands, and they were able to maintain that share. And over the past year, with inflationary pressures, this company's been able to increase their prices as well as increase volumes, which a lot of companies were not able to. So what tells me is that people are willing to pay a higher price and still consume slightly more. And so about 35% of their revenues are in emerging markets. So that is a higher growth area. It tends to be somewhat cyclical at times, but as households become more middle class, they consume more packaged goods. Meanwhile, management has been refocusing its portfolio, getting out of some of the slower growth markets like the developed gum market they're selling, and they're reinvesting into adjacent categories where it's like baked biscuits or cakes and pastries or nutritional bars. They bought Cliff last year, I believe. And so these are categories that are uses kind of similar manufacturing machines, et cetera, processes, but they feel they can use that brand, like Oreo is their brand. It's like the leading cookie brand around the world with $4 billion in revenues. And so they kind of package that in a different format, but use the Oreo brand. So they've been very successful at doing that. And in their second quarter, when they reported, they actually raised their earnings per share guidance to at least 12% year over year. So that's like better than the general market, the S&P 500, because that earnings for the S&P 500 this year are forecast to grow maybe 2%. And it's trading at a, it's a reasonable multiple for a global consumer staples name. So, we're long-term buyers of this stock. And it gives you a yield. It's not a huge, I think it's just above 2% right now.
I mean, they are the leader in cookies. They got about 16% of the global biscuit market. Yeah, nobody is close. I mean, Campbell's, Kellogg's, PepsiCo, they all have biscuit products, but they're nowhere near them.
Yes, that's right.
And they get number 2 in chocolate. 3 in cakes and pastries. Yeah. All those good things. And S&P Global, finally.
Yes, S&P Global, so a financial information service provider. Reason why we like this business, highly profitable. They're in about 5 different divisions. And they're very high margins, operating margins like in the mid 45 to 46%, very scalable, reoccurring, but 72% of their revenues are subscription based, so it's reoccurring in nature. So some of their largest segments that you'd be familiar with, Andy, is their ratings business. So Moody's would be a competitor, and when you have debt outstanding, you have to get it rated. So S&P Global ratings, whether it's new debt that has to get rated, and even outstanding debt has to be reviewed on an annual basis. Secondly, they have the indices business, so S&P, anything, ETFs with that name attached to them, they get money from that. Market Intelligence is their desktop business. Capital IQ is their product there, used by the financial service industry, very critical, providing need-to-have information. And they bought IHS Markit a couple of years ago, Andy, and they provided a lot of commodity pricing, benchmark tools, and fixed income tools, which they're now feeding through their Market Intelligence desktop. So when they bought that company, kind of a new end market, and they've been able to achieve the cost synergies they put out there. And now they're focusing on doing revenue synergies. So we think this is a great long-term hold, great growth story for the longer term. And given the pullback that's had, we would be buying it here too.
Christine, thanks very much.
Thanks, Andy.
Let's get to those top picks. Number 1, Alphabet, and your holding is Google, the voting share.
Correct. Yeah, there's 3 classes of shares, Andy. The A, which is Class A, which is GOOGL. The B, which is only owned by the founders, Brin and Page, and are super shares, so they have a lot of votes attached to each share, and that gives them control. And the C, which is non-voting, and the symbol is GOOG. We buy the voting shares because the A shares and the C shares trade at roughly the same price, and why not buy the share that has a vote? We'd rather have a vote. So we really like this company. It's obviously dominant in search. It owns search. But with AI coming, and their product is called Bard, got off to a bit of a stumble, but they've recovered quite quickly. It's gaining traction. The stock trades at around $130 a share. We think they'll earn $6 a share next year. So if you do the math, that's just a little over 20 times earnings. Very inexpensive for a company that's growing at least mid-teens, and I think it'll challenge 20% a year. A lot of money is spun off from this company. Free cash flow is quite large. A lot of it goes back into R&D, over $20 billion a year, and it's proven to be very, very productive for them. So we think that there's a ton of promise here, and you get it at just a really good price.
Next idea, Jacobs Solutions, the big engineering company.
Right. And this is a company that's going to enjoy the fruits of this infrastructure bill spending. I mentioned earlier in the show about $1 trillion, a little less than $1 trillion, is going to be spent over the next number of years. And Jacobs is right in the wheelhouse of this funding. They're restructuring. They've got 2 divisions. Their critical missions solutions division, they're going to spin off or sell. And there's been some rumors of a sale, but nothing announced. It was more involved in aerospace, nuclear. The area that they're keeping is more of the pure infrastructure, and they call that people and places solution. The fundamentals are great. They trade in the mid-teens. They grow very rapidly. So good valuation for a company that's growing.
Okay. And then finally, Visa, obviously a toll keeper in a lot of the world's commerce.
Yeah, and Visa and MasterCard really control this as a duopoly. Visa much larger than MasterCard, trading right now at a bit of a discount to its historical valuation. We've owned it a couple of times over the years. Sold it last about 2-3 years ago, maybe, when it was trading at about 32, 33 times earnings. And on a valuation basis, just got too expensive for us. But lo and behold, it came back and it back into attractive valuation range, and we bought it again in the $200 range, I believe. It's done very well for us, but it's still only trading at about 25 times earnings, 26 times earnings, so about a 50% premium to the market. Well-deserved, very predictable, growing on an organic basis, but also, this is a company that, as you say, it's the toll keeper in terms of fintech.
And the growth is enough to justify a multiple of about 25 times.
Absolutely, yeah. If you look at the growth rates, it's growing at probably about 4 times GDP. So, yeah, definitely.
Gord, thank you very much indeed.
Thank you, Andy.